What's up everybody, it's Sir Stack here, and let's be real, trading can be a roller coaster. We've all been there riding high on those green candles feeling like total rock stars. But just like a roller coaster, there are dips and turns that can catch you off guard. Today we're diving deep into the 4 deadliest trading traps that can absolutely wreck your portfolio if you're not careful. Now these traps, they're not about some complex algorithm or secret strategy only Wall Street knows. These are psychological pitfalls, those little voices in your head that can lead to impulsive, emotion-driven decisions. And trust me, those decisions, they often end up costing you big time. So, whether you're just starting out in the trading world or you've been around the block a few times, this video is your guide to identifying and avoiding those traps. We're gonna break down each one, talk about why they're so dangerous, and most importantly, give you actionable strategies to stay safe and profitable in your trading journey. Let's get into it. Alright, let's talk about FOMO, the fear of missing out. We've all felt it. You're scrolling through your feed and bam, everyone's talking about this stock that's skyrocketing. Suddenly, you're hit with this overwhelming urge to jump in right now, right this second, before you miss out on all those sweet, sweet gains. But here's the thing about FOMO, it's driven by emotion, not logic. When you let FOMO dictate your trades, you're essentially throwing your strategy out the window and chasing after hype. And trust me, the market loves to punish emotional traders. So, how do you combat FOMO? First off, stick to your trading plan. Remember why you entered a trade in the first place. Have your entry and exit points clearly defined and don't deviate from them just because everyone else is going crazy. Second, learn to embrace patience. Don't feel pressured to jump into every single trade. Remember, there will always be another opportunity. In fact, waiting for pullbacks or confirmations can often lead to much better entries. And here's a little mental trick I use when FOMO starts creeping in. I remind myself that the market doesn't close at 4 p.m. every day. It's open 24/7, and there will always be another trade, another opportunity to make money. So, take a deep breath, stick to your plan, and don't let FOMO cloud your judgment. Alright, let's talk about another trading death trap, oversizing. Now this one's all about risk management, or more accurately, the lack thereof. Oversizing is when you put way too much money on the line in a single trade, essentially betting the farm on one hand of poker. Think about it like this, would you put your entire life savings into a single stock just because you heard a rumor it might go up? Of course not. So why do that with your trading account? The danger of oversizing is that one bad trade can absolutely decimate your portfolio. And let's be real, everyone has losing trades, it's part of the game. But when you oversize, those losses are magnified exponentially. So what's the solution? First and foremost, you need to establish a risk management strategy that works for you. A good rule of thumb is the 1 to 2% rule. This means you never risk more than 1 to 2% of your total trading capital on any single trade. There are also tons of great position size calculators available online that can help you determine the appropriate position size based on your risk tolerance and stop loss level. Before clicking the buy or sell button, ask yourself this. If I lost this entire trade, would it significantly impact my overall portfolio or my ability to continue trading? If the answer is yes, you're probably oversizing. Remember, slow and steady wins the race in trading. Protect your capital, manage your risk, and don't fall into the oversizing trap. Alright, revenge trading. This one's a real killer, both for your portfolio and your mental state. Revenge trading is basically when you try to get back at the market for a previous loss by making impulsive, emotional trades. It's that feeling of, I'm gonna show the market who's boss after a trade goes against you. But here's the thing, the market doesn't care about your feelings. It doesn't care if you're angry, frustrated, or determined to win back your losses. It just keeps on moving. When you revenge trade, you throw logic and strategy out the window and let your emotions take the wheel. And as we've already established, emotional trading is a recipe for disaster. So, how do you avoid the revenge trading trap? Well, the first step is recognizing when you're in that emotional headspace. If you're feeling angry, frustrated, or desperate to make back your losses, step away from the charts. Seriously, close your trading platform, turn off your phone and go for a walk, hit the gym, or do something completely unrelated to trading. Give yourself time to cool off and clear your head. Another helpful tip is to keep a trading journal. After each trade, win or lose, jot down your thought process, your emotions, and the outcome. This can help you identify patterns in your behavior and spot those revenge trading tendencies before they get out of control. Remember, the market doesn't owe you anything. It's not personal, it's just business. Don't let your emotions get the best of you. Stay disciplined, stick to your plan, and avoid the revenge trading trap at all costs. Let's talk about stop losses, or more specifically, loose stop losses. Now, stop losses are one of the most important tools in a trader's arsenal. They're like insurance for your trades, automatically limiting your losses if a trade goes against you. Think of it like this. When you buy car insurance, you set a deductible. It's the amount you're willing to pay out of pocket if you get into an accident. Stop losses are kind of like that deductible for your trades. They define the maximum amount you're willing to lose on a particular trade. Here's the thing. Loose stop losses or constantly moving your stop losses further away from your entry point completely defeats the purpose. It's like buying car insurance with a $10,000 deductible. It might seem like a good idea at the time, but if you ever actually need it, you're still on the hook for a huge chunk of change. So how do you set effective stop losses? First and foremost, your stop loss should be determined before you even enter a trade. Base it on your risk management strategy and the technical levels of the asset you're trading. Don't move your stop losses further away from your entry point just because you're hoping the trade will turn around. That's like getting into a fender bender and then telling your insurance company you want to increase your deductible after the fact. It just doesn't make sense. Remember, small losses are a part of trading. They're inevitable. But by using stop losses effectively, you can prevent those small losses from turning into catastrophic ones. So, set your stop losses strategically, stick to them, and protect your hard-earned capital. Alright, those are 4 of the deadliest trading traps and how to avoid them. Remember, trading is a marathon, not a sprint. It's about making consistent, disciplined decisions over the long term, not chasing quick wins or trying to get rich overnight. Follow a trading plan. No impulsive decisions. Review trades weekly. Learn from mistakes. Trade only when calm. Never trade angry, frustrated, or euphoric. Remember, the best traders are not the ones who make the most money, but the ones who lose the least recklessly. By avoiding these 4 death traps, you'll drastically improve your trading longevity and profitability. Stick to discipline, and the profits will follow. Happy and safe trading.